Hello, for those of you who do not know me, my name is Angelique Collado, and I am currently one of the HOLA committee members here at Sinai. HOLA stands for Heritage of Latinx Alliance, and as an ERG, we aim to foster an environment where all Hispanic and Latinx individuals are recognized and represented. And although we are Latin-based, you don't have to be Hispanic or Latinx to attend any of our events. Inclusion is one of our biggest initiatives here at HOLA. Everyone is included. With that being said, I am super excited for today's event, and in honor of National Hispanic Latinx Heritage Month, I want to welcome you all to the Latinx Money Movement Life Insurance event featuring our guest speaker, Ariel Ferreira. Ariel is a licensed financial professional that instills a peace of mind in families and businesses by providing them with the financial education and services needed to secure their future. Ariel has also trained over hundreds of licensed financial professionals in various states while also receiving accolades from many of the top financial firms in this country. His work evidently shows his passion to close the financial literacy gap for the everyday American to ensure the betterment and security of our future generations. Today, Ariel will be discussing the importance of making life insurance part of your financial strategy and showcasing the different uses and advantages that will benefit both you and your loved ones. So without further ado, Ariel, the floor is yours. Thank you.
Angelique, thank you so much. I truly appreciate that introduction. Truly appreciate you having me here. And I'm excited to be here, not only because we're celebrating Hispanic Heritage Month, but also because it's Life Insurance Awareness Month. So it's awesome to be celebrating both things together, especially on this call with everyone from Mount Sinai. Now, folks, look, I'll tell you a little bit about myself, right? I'm excited to be here because I remember back in the days when I had no financial literacy around life insurance or finances in general. You know, I'm Dominican. I was born and raised in Washington Heights. My parents are both immigrants. They taught me everything that they could so I could become a stand-up gentleman. But one of the things that they didn't teach me was financial literacy. And I made a lot of mistakes. You know, I made great money, but I also spent great money. But in the process of me starting my family and getting married, you know, I always say that women turn boys into men. So when I was getting married, I realized, look, I need to learn how to keep this money so I could keep my wife, right? And I got a financial coach, and he taught me more about money in the first 30 days than I ever did in my entire life, and put my family on a totally different track financially. And that's what got me involved in the financial industry. It was to share with other people the information that was shared with me so that they could change their lives the same way I changed my life. So I'm excited. I'm passionate about sharing information and educating folks. So today we're going to be talking about life insurance, and particularly in the Latinx community. Now, one of the things I'm super excited to share with you is that, you know, in 2020, the Latinx community represents 62.1 million people. Right now, we're representing about a little over 18% of the United States population. This was based on a research from Pew Research Center. And we're the second fastest growing population segment since 2000. Now, one of the most important things is that we've broken our records, and we hit milestones as we're growing, right? We're increasing in home ownership. We're increasing as one of the leading small business ownerships, and people that are launching small businesses is led by the Latinx community. Now, we're growing everywhere, but there is a cause for concern. There is a setback, and it's this. You know, although we represent about 18% of the population, we only hold 2.8% of the wealth in the United States. You know, so this is super important. Now, why am I talking about this? I'm talking about this because life insurance is a great tool to create and protect wealth. One, you know, if you have real estate property, if you have a home and you want to protect that wealth, and you definitely want to have life insurance to make sure, God forbid, something happens to you, that home is protected, or the mortgage is protected by life insurance. And we'll talk a little bit more about that. And then there's also cash value life insurance. Cash value life insurance can be used to be able to create wealth, to create supplemental retirement income, to create generational wealth. And that's something else that we'll talk about as well. I'll touch on both of these 2 points, but it's a huge concern in the Latinx market. And I was excited to see the chat, because these are some facts, right? This is a report that was released by Life Insurance Marketing and Research Association on the facts about life insurance when it comes to the Latinx community. So 78% of Latinx say they need life insurance. However, 51% report that they don't, hold on one second, my screen is a little cut off here, report only owning life insurance. And 33% wish, that their spouse had, that they don't have enough, and they wish, 41% wish that their spouse had more coverage. And the most alarming part, we talked about protecting wealth and creating wealth, right? But look at this fourth one, 44% of Latinx households, they would face a financial hardship if one of the breadwinners in the household would pass away within 6 months. 20% will face that same hardship in less than a month. We're talking about 64% of the Latinx population. If there's not a life insurance in place and one of the breadwinner passes away in the home, would have some sort of financial struggles. And then there's some misconceptions. Latinx community, they believe that life insurance is just too expensive, yet a huge portion of them overestimate the cost of life insurance. And a third of the population, they pretty much, they would love to get life insurance. They just don't know where to start or don't have the information to do so, to get the right one, or they don't feel they're educated enough. So I'm excited that you're going to be here. And I saw the chat, right? I saw somebody said, what about term versus whole life? And it's a great question. But one of the questions that I always ask when somebody comes to my office and tells me that they want life insurance, the reason is why. There are many different types of life insurance, and you can use life insurance for many different reasons. You can use it to protect your family. You can use it to protect your mortgage. You can use it to get living benefits or long-term care protection. You can use it to create supplemental retirement income, cover educational expenses for your children, replace income, final expenses. You can use it to create wealth, and most importantly, to protect yourself. So depending on the reason why you want life insurance is going to determine what's the right type of life insurance for you. For some people, it's term. For some people, it's whole life. For some people, it's universal life. And there's many other different types of life insurances. And we're going to get into that conversation today on the different types. But let's talk about first, where do you get them, right? Where can you get life insurance? And I saw about 77% on that poll. Thank you, Angelique, for conducting that poll. But I saw 77% get it from their employer, and that is great. That's one of the best places to get it. Why? Because you don't have to go through any medical underwriting when you get life insurance through your employer. Now, there is a cause for concern in that area. Why? Because most of the time, the life insurance that you get through your employer is only active, and you can only have it while you're an active employee for that firm or that company. The moment you resign, retire, or even get fired, right, you can lose that benefit. And even if you have the option to transfer it over to your personal self, it might be more expensive because the employer gets it at a group discount. So always want to make sure that, yes, get your life insurance from your employer, but always make sure that you could get one outside, an independent one. Why? Because, as I said earlier, if you resign, retire, get fired, God forbid you get sick before any of those things happen, and then you leave your job. Now you no longer qualify for life insurance. You lose the life insurance from your employer, and now your family has no coverage. Another way of getting life insurance is through associations like AARP. They have different membership discounts when it comes to life insurance services. Then you have insurance agents. You could get insurance agents that work for direct carriers like a Nationwide, a Prudential, directly from them. The only cause for concern in this area is that insurance that works for that direct carrier could only provide you the life insurance that their company provides. They cannot give you multiple quotes like an insurance broker. An insurance broker is able to give you multiple quotes. They're able to shop around. They're able to find different companies, compare different rates, and be able to find what's the right company for you, the right life insurance for you, and most importantly, that's within your budget and it's in alignment with your goals. So now that we understand where you can get life insurance, it's important to, we're going to give you a life insurance 101 course, right? So we're going to talk a little bit about different types. So the first type of life insurance is the one that everyone hears, term life insurance. Now, this is a temporary life insurance. It covers you for a specific period of time. It could be 10, 15, 20, 25, 30 years. After this time period is over, it expires or the rate goes up. It's a very fixed premium, and it's one of the most affordable life insurances on the market. The reason why it's so affordable is because it expires and only covers you for a specific period of time. It'll give you the death benefit coverage, and it also has living benefits. We'll talk about living benefits in the next couple of slides. But what is term life insurance great for? term life insurance is great if you have a home and you have a mortgage. So you have a 30-year mortgage, you want to get a 30-year term in the amount of the mortgage. God forbid something happens to you or to your partner, then the mortgage can be covered and the person that survives is not forced to sell the house under pressure or go into foreclosure. Another reason why you get term life insurance is great when you have small kids. The reason why is you want to get the most bang for your buck in terms of coverage, because God forbid something happens to you, you want to make sure that your spouse or your partner has enough financial power to take care of your children and replace your income. So it's also something very great to have term life insurance. So that's number one. Number two is whole life, right? So I know somebody mentioned whole life in the chat. And here, pretty much, this is a permanent life insurance. Now, the next two life insurances I'm going to talk about are permanent life insurances, and they're also cash value life insurance. But whole life, you got a locked in premium. So if you're paying $150, you're paying $150. That's not going to change for anything in the world. Now, it's going to create some cash value for you. You can create wealth through whole life. Now, how does that cash value grow? You get a fixed interest, right? Could it be anywhere from 1% to 3%? That's usually the average in most whole life companies. And you could also receive dividends. Dividends are pretty much what we call overpaid premium. When the company's making profits, you get these additional premiums and you could get more life insurance. If some of you have whole life and you look at your statements, you can look at the paid up addition, and this is usually what dividends pay for, right? And the next thing is this can be expensive depending on the benefit. Actually, whole life is, it's one of the oldest life insurances that's been around. You could get living benefits, but it's also the most expensive form of life insurance that exists in the market. Now, why do you get whole life? You get it pretty much once so you can have permanent life insurance. You want to be covered for the rest of your life. You could get a term life insurance for 30 years. Yeah, that's great. But after 30 years, think about it. If you're 30 years old and you get a 30-year term life insurance, at the age of 60, when that term life insurance expires, do you think that your insurable needs or you still need some coverage to protect your family? 9 out of 10 times, most people still want life insurance, especially to cover their final expenses. So you want to get a whole life that's going to cover you for the rest of your life, right? Now, the next one is universal life. Universal life is also permanent life insurance. It's cash value. One of the things that I love about this one particularly is you have a flexibility when it comes to a premium. So if you're paying $150 a month, that's great. But if you're in an emergency, maybe you're going through some tough times, you could probably reduce your payment to $100 or $75 to a lower premium and not lose your policy. Now, if you want to accelerate the cash value, instead of paying $150 a month, you could probably even pay up to $300 a month. And that's going to go into your cash value. And we'll talk a little bit more about how cash value works. And then here, you also have increasing death benefit. You have the ability of getting that. In most whole life policies, when you get a whole life, it doesn't matter what cash value you have within the policy. You're going to get the death benefit coverage, and whatever additional life insurance that you buy with your dividends is what you're going to get. So let's say you have $200,000, right? If you have $200,000 of death benefit coverage and $100,000 in cash value, your family's going to get $200,000 in the whole life. In a universal life, your family could get both. Your family could get the death benefit coverage, the $200,000 plus the $100,000. They could get $300,000. They'll get a combination of both. On top of that, you get the living benefits. We'll talk about that again. And then there's 3 different types of universal life. You got a standard basic general universal life, and that grows on a fixed interest. It's a little bit higher than a whole life. It's usually 3 to 5%. And they might have some other credit interesting options depending on the company. A variable life, the cash value is actually in the market. Your money is participating in the gains, but it could also participate in the losses. And then the last one is index universal life. And here you pretty much have your money getting credited based on how the market is performing. However, you have 100% protection on the downside of the market. What do I mean? If the market does 6%, you're going to get 6%. If the market does -10, you're going to get 0% because you have a floor protection on your money. Now, some index universal life companies provide a cap. So if you have a 15% cap, if the market does 20, you're going to get a 15%. So those are the different types of universal life insurances that exist. The next one is final expense life insurance. Final expense is pretty much what I mentioned. Usually you get these for a population that's within the ages of 50 to 85 years old, usually for seniors, and it's pretty much to cover just the final expenses, for burial expenses, cover the funeral home, cover the burial grounds, et cetera, et cetera. And then the last one that I do like to share with everyone, I like to educate people on this, because a lot of people, I've been in a lot of kitchen tables where people think that they have a full life insurance and they have this. So this is what we call accidental and dismemberment life insurance. You could get this as a standalone product, or you could get this as a rider on a life insurance. So I'll kind of explain. This covers you only if you pass away in an accident. So if you pass away in an accident, is how your family gets paid. If you die of a natural cause, your family does not get paid. And it's a very great area. I remember, speaking to someone that there was a gentleman who had accidental life insurance, and he was in a car accident, pretty much died in the car accident. And what ended up happening when the autopsy report came, he ended up dying actually of a heart attack. So he was in a car accident, he probably survived, but the anxiety and the panic led him to a heart attack. And when the life insurance company saw this, since it was an accidental, they did not pay the family the life insurance coverage. So you want to make sure that you have a life insurance that is full coverage. An accidental life insurance covers you only accidental. If you get it as a rider on your life insurance, then usually it's to get an additional amount on top of your coverage. So your initial death benefit coverage might be $100,000. Your accidental rider might be $50,000. If you die of natural cause, your family gets $100,000. If you die of an accident, your family gets $100,000 plus $50,000, a total of $150,000. So just wanted to explain these. Now, one of the questions that I also want to share with you is, people ask me, when the family gets the proceeds, is it tax-free? Yes, so your family gets a tax-free death benefit. So if it's $500,000, $1 million, $250,000, $100,000, whatever the family receives from the death benefit is 100% tax-free. As far as the cash value growth and cash value policies, you have tax-deferred earnings, but you also have tax-free withdrawals where you can access the money in your life insurance tax-free. How do you do that? Well, whatever you put in, you can take it out tax-free. Any money that grows, any interest or gains on the account, you can take it out as a loan. Why? Because you never pay taxes on a loan. So these are some of the things that you want to have a conversation with a life insurance agent to really get a grasp on these things. Now, most people, one of the questions that people say that they ask other people is, what are you paying for your life insurance? How much are you paying for your life insurance? You cannot compare your life insurance premium with someone else's because everything is case by case. See, life insurance rates and premiums are based on all of the items that you see here on the screen. It could be height and weight. It could be health issues, past or present, medications that you've taken in the past or you're taking now. Are you using tobacco? Family history. And look, I'm going to talk about using tobacco. Marijuana is legal now in our state, but according to life insurance, you would still get a tobacco rating for smoking marijuana. Now, there's some companies that are a little bit more flexible when it comes to smoking marijuana. So you want to take that into account. And that's why it's great to work with brokers. If your driving record is not up to par, maybe you're speeding a lot, you might have a high risk. If you have a past criminal record, if you participate in high risk activities, these can all differentiate what your premium. You could be two people, same age, same height, same weight, but if you have two different driving records, your premiums will be totally different. So it's important to make sure that you want to get qualified yourself and get your own rating so you can understand what your premium are. Now, I see some questions in the chat. We'll answer those questions at the end of the presentation, just so I could keep it with the flow. I might answer some of your questions. Now, the next question is, we talked about being underinsured. How much life insurance do I need? In the industry, we use what we call the die method. The die method is pretty much you add up all your debt, you take your income, usually your income, we multiply it by 10. And then if you have a mortgage, we add that into the formula. And if you want to leave educational finances for your children, if you have small children, you want to leave some finances for your children to go to college, then we factor that in. Right now, in the industry norm, we're usually averaging about $30,000 a year. So multiply that by 4, that's about $120,000 per child per college. And then if you have any life insurance in place, you subtract that from that total. And that's going to let you know if you have a shortfall or if you have a surplus of life insurance. So I'm going to give you a quick example. So here is a die method. Let's say you're $50,000 in debt. You have income. Let's say your income is $36,000. You multiply that by 10, that's $360. Your mortgage is $200, and your education, one child, $120. Your total insurance need is $730,000. So you want to be able to make sure that you can get this. Now, one of the great ways, sometimes people tell me, I want to get all of that in whole life insurance or a permanent life insurance. That could be super expensive and outside of your budget. So a great way that you can get to this is a combination of both. You could have a whole life and a term. You could have multiple life insurances for different strategies. The most amount of life insurance that you could get, you cannot get more death benefit coverage than 25 times your income. But you could get many different types of life insurances as long as it's within that threshold. So super important to understand. Now, the important riders that you want to get. You want to look at disability waiver rider. The disability waiver rider is pretty much if you ever become disabled, your premiums will be waived and you will not have to pay your premiums for that life insurance and it will still remain intact. You never know if that could happen, but if it does, at least you're protected. Living benefits. Now, most life insurance companies have been upgrading. They've been upgrading throughout time, kind of like your cell phone. Some of you are probably on your cell phone. Some of you probably remember rotary phones. I remember that, right? And they upgrade, right? We've been upgrading on our cell phones every year, right? The new iPhone just came out. Well, life insurance companies are upgrading their policies every single year. A policy of life insurance from 10 years ago, it might be time that you need to look at it, get an audit, and probably upgrade it. Because some of these companies are now doing hybrids where you can get living benefits. So if you ever get diagnosed with a terminal, critical, or chronic illness, you could get access some of the proceeds of that life insurance while you're still alive to cover any of the medical expenses. Then long-term care. Long-term care is a huge concern. I just got off the phone with a client who's worried because his father's in a nursing home and he's worried about himself. How am I able to cover nursing home costs later when I'm at his age? How am I able to do that? So it's getting long-term care protection. Now, some of these life insurance companies are providing a hybrid with a long-term care rider. Why is it so important in the Latinx community? Because there's a lot of concerns when it comes to our health. Obesity. Latinx are 1.2 times more likely to be obese than non-Latinx whites. Diabetes, more than 50% of Latinx are expected to develop type 2 diabetes in their lifetime. 1 out of 4 have high blood pressure. 1.5 more times likely to have kidney failure. And actually 20% of the people waiting on the list for a kidney transplant are Latinx. We also have a high risk when it comes to chronic liver disease. And this was based on a report from Northwestern Medicine. And then last but not least, on a publication by the American Public Health Association, Latinx, we live the longest. We have a longer life expectancy than whites, blacks, and Asians. We actually live to about 78, 79 years old. Now, why is that important? Yeah, you might be celebrating we live a long life, but when you live a longer life, it's inevitable for more opportunity for illnesses or more opportunity for the need for long-term care services. Now, what's long-term care? Long-term care is the need for assistance or supervision with activities of daily living. So usually the daily activities that you see on the screen, if you cannot complete 2 out of these 6, you will qualify for long-term care services. However, long-term care services, their costs can be very high and they're continuously going up throughout the years. Back in the days in our Latinx community, our long-term care service provider used to be our relatives. I remember growing up, my grandmother, my grandfather, my mother used to take care of them. She used to help them with the informal assisted living. She used to provide them all the assistance that they needed. But now, as we continue to grow and evolve as a population, and there's more of a need for people to work and more a need for people to provide in the home, very few relatives are in a position to take care of their parents nowadays. And later on in the future, our children are not going to be in a position or might not want to be in a position to take care of us as well. So there's some thoughts versus facts, right? So some of the things, it won't happen to me. Well, 70% of Americans above 65 end up needing some sort of long-term care. And if we're living a longer lifetime, it's not a matter of it won't happen to me. It's about when will it happen to me? And that's the right mindset. Then the next thing is, Medicare and Medicaid has me covered. Well, when it comes to long-term care services, Medicare pays only a portion of the cost. It's up to 100 days. After that, you're on your own, folks. And then Medicaid is only available to those with limited assets and limited income. So you practically have to go broke and let go of all your assets in order to qualify for Medicaid, and most people don't want to be in that situation. And then last but not least, that's what my savings are for, right? The national average cost for long-term care services is either $105,000 per year. And my family will take care of me. We kind of spoke about this, but really quick, 72% of those surveyed worried that they would not be able to provide adequate care if somebody in their family needed it. So how do you take care of yourself using living benefits and long-term care through your life insurance? So these are some riders that you can get through your life insurance, and you want to make sure that you're up to date and covered in those areas. Now, we're going to talk a little bit about cash value life insurance. So we kind of talked about the basics. We talked about the different types. We talked about some riders that are important. We talked about what different rates are, and why there's such a huge need for us to have the riders and life insurance in the Latinx community. Now, cash value life insurance is super important, and you can use it as a supplemental retirement strategy. Now, when I get somebody comes to my office, right? Somebody comes to my office and all the time, what I've come up with is what they want is the ideal investment. When I ask them, what ideal investment do you want? They mention these 4 things. Everybody wants their money to be safe. They want their money to be safe. They work so hard for it. They've been contributing to their 401k. They don't want it to grow anymore. They want it to be safe, and they also want it to grow. And most people want access to their money. They want liquidity. And, we all have this uncle that we don't know how he became our uncle. We kind of don't like him. We don't want to invite him to the barbecue. But then there's Uncle Sam, right? We want to make sure that our money is also tax-free. And in most situations, that's what people consider an ideal investment. Now, the majority of folks are using 401ks, 403bs, 457s, and IRAs as a form of retirement. Now, there's nothing wrong with that, but you can add cash value life insurance as part of your portfolio to strengthen your retirement strategy. And why is that? Let's talk a little bit about these vehicles. So are they safe? In 2008, there was a market crash. They said most 401ks lost about anywhere from 35 to 40%. In the beginning of the pandemic, we saw this crash as well. It was about 30%. So think about it. If you're about to retire and you have $1 million and you have a 30% loss, you would have a loss of $300,000, right? If you're about to retire, this can be devastating. If you're young, you can still rebuild back up. You still have time. And then the next thing is the growth, right? We can analyze the growth. You can make great returns. However, losses can have a big impact. If you lose 10% in the market, you need 11% to gain back your money. If the market loses 30%, you require the market to go up 43% in order to break even. So you can make great money, but these impacts do have losses on you building wealth in the future. And then consider the following. Is it liquid? Well, you have a 59.5-year rule. We all know this. If you take your money out before 59.5, you get penalized 10% and you got to pay state and federal taxes. And also there's the loan interest, right? Depending if you're taking out a loan. In some companies, it could be anywhere from 5 to 8%. So your money is not as liquid as it seems. And these are all information that you can look up in the IRS website. We'll provide these slides to you so you can look at the links. And tax deferred, right? You get taxed on the withdrawals. And then one thing to think about is also the legislative risk. Most people, when we talk about retirement, most people don't take into account what we call legislative risk. That means that the government, they can change through legislation whatever taxes are. And if you think about it, in the last 2 years, the government has given away trillions of dollars. And most importantly, last year, they almost went bankrupt. So what happens when a country is going through financial problems? They raise taxes. There's actually a law that's going to sunset in December of 2025 that's going to increase income tax brackets. So you also have to be mindful of this within your tax strategy for your retirement. Then you have required minimum distributions. You're required, let's say you retire, you don't need your money, you're doing great with a pension, you're doing great with income or any other income that you have, you don't want to take out your money. Well, you have required minimum distribution. If you don't start taking out your money by the age 72, you can get taxed. You'll have to pay a 50% excise tax on the amount that you did not distribute as required. And you can look this up on the IRS website. Links are provided as well on the bottom. Now, so we kind of discussed it. Ideal options, save. Not really. Growth, you have potential. Is it liquid? We already talked about penalties and taxes. And tax-free. We spoke about that as well. So how does using cash value life insurance operate as a supplemental retirement income? Well, first, let me help you understand how it works. So this is kind of like your whole life and your universal life. You make a payment to your policy. A portion of that will go towards the policy charges. That's the cost of insurance, administrations of the policy, the management. And then the remaining portion of that is allocated either into an indexed interest strategy or to a fixed interest strategy. Those funds are going to build cash value over time that you could use later on in the future. Now, let's talk about the same thing, right? When it comes to safety and growth potential, well, depending on the life insurance that you have, you might have a fixed growth where you have a fixed interest. It provides guarantees, not necessarily outpace inflation, but your money's kind of growing and it's building cash value for you. Index life insurance policies, what they do is that they provide you market upside gains, and you also get market downside protection. So if the market goes up, your money goes up. Once it goes down, your money locks in and it peaks because it has 100% protection. So you have safety in these two different strategies when it comes to building cash value, and you also have some growth potential. And then as far as liquidity, when it comes to cash value life insurance, there's no 59 and a half year rule. So you can take your money out when you need to take it to use it for whatever you need to use it. There's no required minimum distribution. So you can leave your money in there for as long as you want. You can take your money out through tax-free loans and withdrawals, and your family gets a tax-free death benefit. And then last but not least, let's look at this, right? Is it safe? Yeah. Does it have growth potential? Yes, it does. Does it have liquidity? It does as well. And is it tax-free? Absolutely. So I'm not saying 401k and 403bs and IRAs are bad. We just need to supplement it with an additional retirement tool that can be used to also create supplemental retirement income for you later on in the future. And if we compare it, right, people say, let's compare it to all the other vehicles. Well, let's look at this, right? Here we're comparing it to life insurance, mutual funds and stocks, Roth IRAs, annuities, traditional 401ks, and health savings accounts. So we kind of look at this is kind of self-explanatory, but if we look at this chart, life insurance checks more of the positive boxes than most of the other vehicles. Got tax-deferred growth, tax-free income tax-free death benefit for your family. There's no penalty for early withdrawals, and there's no contribution limit like there is in most policies. Now, if you look, right, so most people think, my retirement plan, if my family gets my 401k because I passed away, most people think that they're gonna get it tax-free. Actually, your family would have to roll it over into what we call an inherited beneficiary IRA, and they would still have to pay taxes money that they receive from any of your investment accounts. So super important to understand this. Now, I'm going to finalize with one last strategy, is that you could use cash value life insurance to create wealthy children, right? And this is something to think about. You know, I have a 6-year-old son, and one of the things that I thought about as he's been growing up and when he was born, is that I realized that children are like a box of chocolate. You never know which one you're going to get. And a lot of us want to think about college planning, but we don't know if our child's going to go to college. We don't know if they're going to go to college and have a full scholarship. We don't know if they're going to want to start a business and not go to college. So one of the things I talk to parents about is, instead of college planning, start thinking about life planning for your children. They're going to go through the same 4 stages that we go through. The first stage is they're going to go to college. Second stage is they're going to start a family. They're going to want to buy a home. They want to buy a car, maybe start a business, maybe get married. And the third stage is that they're going to want to retire. Same way that we want to retire, they're going to want to retire. They want to travel. They want to have freedom. They want to maybe donate to a charity. And then they're also, going to pass away, right? So they're also going to need death protection for your grandchildren. So start thinking about life planning instead of college planning. And, I was talking to someone earlier today that, I remember growing up, $100,000 was like a big thing. Today, $100,000 is nothing. $1 million is a big thing. But when our kids are growing up, $1 million is going to be nothing. It's going to be the new $100,000. So how do you start preparing them to build wealth for their future? So one of the things that we do is that we use what we call $1 million baby plan. And this is pretty much, it's not an actual plan. It's a strategy through what we call a cash value life insurance with a built-in savings plan. You can open it up for a child after 15 days of birth. These plans have existed since 1847 and I don't want to say thousands. They've helped millions of families. Why? Because they produce stable returns regardless of market volatility, and they create long-lasting wealth. So pretty much here, you have the benefits of $1 million baby plan. Unlike a 529 plan, a cash value life insurance is not considered an asset for financial aid. You have steady, predictable, tax-free growth. You could use the funds for tax-free income, and your child could use the funds for any financial need in life. With a 529 plan, there's a lot of restrictions. Yes, your money grows tax-free in a 529 plan, and you could withdraw it tax-free, but only if you use it for qualified educational expenses. If you don't, you get penalized 10%, and you have to pay taxes on a state and a federal level based on your tax bracket. You could use the funds in these plans while it continues to grow. Parents, grandparents, legal guardians can open these plans. You can transfer ownership to your child at any time after they become an adult. And the great thing about this is that these cash value life insurance also come with living benefits. And the younger you get it for your child, if something comes up later on for them in the future, I've heard about 12-year-olds, 13-year-olds, 14-year-olds that come up with cancer or some illness. The younger you get it, they will be permanently covered regardless of what illness or anything that might pop up later on in the future. This is an asset that either you or your child can use for retirement, and it's also creditor protected. So if your child comes across a lien, a judgment, or a bankruptcy, no one can touch this money. So I'm going to kind of show you an example, right? And this is only for illustrative purposes. This is a case-by-case basis. You have to sit down with a licensed financial professional to create a case for you. But this is actually one of my clients. It's 1 year old. This is $250 a month. Initial coverage is $164,000. This is using an index universal life. So they're kind of max funding this strategy. And if we kind of look, right, start off at $250, that's $3,000 for the year. By the age 18, they'll have about $56,000, and they could start taking out $10,000 a year, let's say, to cover any living expenses in college. Throughout those 4 years, they took out $40,000. They still have $43,000 left. If we go to stage 2, now by the age 30, they're going to have about $105,000. By the age 40, they'll have over $225,000 that they have access to. Right? God forbid something happens to them at this age, their family is going to get a combination of the death benefit plus the $225,000. It's about $564,000. So they're getting a combination of that. Now, think about this. Let's say your child is 34. They get married. They have a child, right? By 52, 18 years later, your grandchild is going to be going to college. But your child, because they have this policy, can have about $500,000. Do you think college planning is going to be a concern for them? Absolutely not. So this is how you also start not only taking care of your child, but you start taking care of your grandchildren that may not even be born yet. And we fast forward a little bit further to 64, this child will have a little over $1 million, and they can stop paying, and they can now start an income, a policy income, to supplement their retirement of close to $90,000 tax-free. And on the flip side, on the flip side, the death benefit continues to go up. So God forbid something happens to them, your grandchildren will get $1.2, $1.3 million on the death benefit side. The income side, they could do this, let's say all the way up to age 85. They put $189,000 into this policy. They were able to take out over 20 years, they were able to take out close to $2 million. So this is how you could use a cash value life insurance also to create wealthy children. And this is kind of the way it would also similarly work when you use it as a supplemental retirement tool. Now, every parent wants to be proud of their children or their child, but it's also important that they are proud of us. Now, folks, we went over all the information. I see that there's a couple of questions. I definitely want to be able to answer your questions and take some time for that. So I'm going to kind of like just open this up. If you have some questions, definitely put them in the chat. If I take out a loan, is the interest paid to me or the company? That is a great question. That depends on the company and the type of loan that you have. Many different types of companies have different types of loan structures. So they might have what we call a declared loan rates. They might have an alternate loan rate. So it's good to sit down and discuss that with the specific policy that you have. Next question is, can you talk a little bit about using life insurance to protect your estate? Awesome, great. So that's kind of something that we were talking about earlier, right? So getting a term life insurance. So you have a real estate, right? Let's say you have a home, and you have a 30-year mortgage. You want to make sure you got a 30-year term to be able to cover that mortgage so you can keep it within the family. The other, and talking to Sean's point, talking a little bit more about estate. Now, you have an estate that's worth more than 12 I forgot the point right now, but 12 million, let's say $12.1 million. If your net worth in terms of estate, if you pass away and you transfer that to your family, you have to pay estate taxes, right? If your net worth, if your estate is less than that, you don't have to pay any estate tax. But if it's more than $12.1 million, you pay an estate tax. An estate tax is usually the highest form of tax. It's usually like 40%. Why? Because you're not around to complain about it. So what most wealthy people do is that they use life insurance to be able to cover the cost of that estate tax when they're transferring wealth from one generation to another generation. So that was a great question, Sean. Is there an age cap for the $1 million baby plan? My child is currently 6. We have a college fund for her, but this piques my interest. Great question. So you can actually open this up for any child after 15 days of birth. After 15 days of birth. So you don't have to wait till they're 5, till they're 4, till they're 6, any specific age. After 15 days of birth, you could acquire a $1 million baby plan for one of your children. Is age 55 too late to look into whole life insurance or universal life insurance? To be honest, if you're going to look at it for a wealth building perspective, it might not make sense depending on your budget and if you're max funding it. If you're going to look at a whole life or a universal life, you're probably going to be looking at it mostly for the permanent protection, and you're going to be looking at it mostly for the living benefits and long-term care rider. Now, you may not be able to build an enormous amount of wealth within it, but you will definitely can get those benefits on a permanent side in terms of those in terms of the protection side. I hope I'm answering everyone's questions here. Just type a yes in the chat. I recently obtained a life insurance for 20 years. Can I change it to a 30 years? Will I be penalized? So you got a 20-year, you could definitely change it. You will not be penalized. for anything. You can change a 20-year to a 30-year. However, you do need to reapply for it. So once your policy is set in place, so if you have a policy already set in place and you want to change it and upgrade it, you're going to have to go through the same underwriting all over again and reapply. Unless you just got it like a month ago, then you could probably change it very, very quickly. If I access the living benefits, will it affect the death benefit? Yes, it will. So for example, I know Nationwide has a terminal illness rider. So let's say you have a $500,000, you could actually take out $250,000. If you have a $500,000 death benefit protection with Nationwide's living benefit, with Nationwide's life insurance, if you take out their terminal illness rider, you can take out $250,000 while you're still alive if you're diagnosed with a terminal illness. So if you take out $250,000, your family will not get $500,000 anymore, and they will get $250,000. So it does affect your death benefit. Now, I see some questions in the chat. It's a little bit easier if you put your questions in the Q&A section instead of me scrolling through the chat. But I'm gonna try this. My son is 16. Is it too late to start the baby plan? If not, how much do I need to start with? That's a more personal question. That is more case by case. It would definitely be a conversation to have. But if they're 16 and you're looking about using it for college planning, it will be a little too late. But you can start a policy at 16 to start the life planning for your son and preparing him for later on in the future. The earlier you start, the better it is, right? So I think I'm running out of questions here. Let me see. If there are any more questions, feel free to ask. Other than that, I'm going to turn it back over to Angelique. Angelique, thank you so much. I hope this was informative. I hope, this will impact your family. You're able to get the right life insurance. If you have any questions and want to have more of a one-on-one conversation, you feel free to send me an email or give me a call or shoot me a text. I would be more than happy to sit down with you on a one-on-one basis and help you with your insurance needs. Thank you so much. Angelique, I turn this back over to you.
Thank you so much, Ariel. 1 second. So hopefully everyone learned a lot. It was a lot of information, but there's so many great factors and so many great points that Ariel had mentioned. And then like this, we can see all of the different benefits that come with life insurance. So for you, for your kids, for your loved one, everyone has benefits from purchasing life insurance. So what I'm going to do very quickly, I'm going to share my screen. 1 second. Okay, and here I do have Ariel's information. Also, if you have any questions at all about today's event, you can shoot me an email at angelique.collado@mountsinai.org or send an email to Sean as well. We also have 2 QR codes, so I would appreciate if you could all complete our event survey just on your overall experience with today's session. What were things you liked? What were things you feel we could improve on? Any suggestions or feedback that you would like to provide us with? We are more than happy to look at those. So scan this QR code, it'll open up the event survey. And once that is completed, we also have a QR code to become an HOLA member. So hopefully this got you excited. Maybe you want to suggest some ideas for any future events. Again, we are also very happy to hear those out. So feel free to ask more questions. We do have a couple of more minutes. We have about 6 minutes left. Anything in the chat that you want to share? I do see that everyone found this very informational, helpful. Great. Awesome. This is being recorded. And then we'll talk with Ariel in regards to sharing the PowerPoint slides. Oh, let's see. It looks like 1 second. Let me stop sharing. It looks like the code was cut off. Give me 1 second. Let's try this again. All right, and let me know, or maybe let me just not expand it. It might be easier this way. Looks like the bottom half is cut off when I do it in a presenter view. All right, so just use your cell phones. We do have some additional questions in the chat, Ariel. I don't know if you want to address those.
All right, let me scroll up. I'll definitely look for them.
One of the questions that I see in the Q&A feature is, can I take money out from a term life insurance policy in the future?
No, so term policies do not create any cash value. Only whole life and universal life policies create cash value. Term life insurance, think of it like your car insurance, right? Or your cell phone insurance. You pay a monthly fee and you get covered. So if you stop paying for your car insurance, then you don't get any coverage. But that's exactly how term life insurance works. So it does not create any cash value for you. The only way you're able to take out cash from your term life insurance is if you have living benefits and you get diagnosed with a terminal, chronic, or critical illness. Then you're able to access some of the proceeds, depending on the company. That percentage can change of that death benefit coverage. You could take it out. But as far as using it for retirement income or using it for any other purposes, that cannot be taken out. That cannot be created through term life insurance.
All right, great.
For religious purposes, when a person passes away, what is the process to receive the proceeds? Also, is an autopsy required after the autopsy is not required. What you do need is the death certificate, where you could get that from the city or the state. Usually you get one in advance from a hospital, but usually what's required is a death certificate. You did not need a full-fledged autopsy to be able to get proceeds from your policy, from a claim. Now, the only time that they might ask for an autopsy is most life insurance companies have a contestability clause within their life insurance policies. And they also have a suicide clause. So those two clauses, the first one, the contestability clause, is that within the first 2 years of the policy, the life insurance company can actually investigate to see if all of the answers on a life insurance application was actually accurate and that the policyholder did not lie about anything. And if they see that there might be some red flags through their investigation, they might want to see an autopsy to see that everything was coherent with the answers on their application when it comes to the medical aspect. The suicide clause is if anybody gets life insurance and commits suicide within the first 2 years, the life insurance company will not pay out because they'll see that as fraud. They see that as somebody just got life insurance and they wanted to commit suicide and pay off so their family could be rich. So those are two clauses that are super important to understand.
Great point. Ariel, another question we have from Jeffrey is the cash value available as soon as I'm approved for coverage?
Great question. So some companies, depending on, most companies, it takes some time for you to build cash value. And it could be based on different ways that you fund that policy and the type of policy. And some companies actually have riders that will allow you to access that cash value immediately. So it's a case-by-case basis, depending on the company, depending on the design of the policy, and depending on how much you're putting into this policy. So that's a very loaded question, but those are all the different things that can affect whether you have, access to your cash value. Also, I will say this, most of the permanent life insurance companies do have what we call a surrender charge period, usually about 10 years, and it's usually a percentage that's descaling. So that might affect the access of cash value that you have access to. And usually what those surrender charges are, if you ever cancel your policy, you'll get hit with a surrender charge penalty, right? Now, I had some questions. Any tips on best insurance companies or agents? Many companies that offer life insurance, is one better than the other. There's a lot of ratings out there. You can do some research on these companies. The insurance agents, I always like to say this. If the insurance agent is not asking you what you're trying to accomplish, what your goals are, and they're not trying to help you in your budget or not trying to help you in your alignment to accomplish what you want to accomplish, that might not be the insurance agent for you. So that always pay attention to what questions they're asking you versus the information that you're giving, because you want to make sure that you have an agent that's working in your best interest instead of their own best interest. And nowadays, a lot of us, everybody actually has to be in your best interest because there's suitability laws in place. But make sure that they're operating in your interest and not trying to do something totally different than what you want.
Perfect. Well, thank you so much, Ariel. Again, this was such a great presentation. Thank you all for attending this event. Like I mentioned earlier, hope this was very informative. Hopefully this got you excited to start working on your financial strategy and using these different avenues and vehicles, like Ariel had mentioned, to better yourself in your future. So once again, I hope everyone had the opportunity to complete the OLA event survey as well as becoming an OLA member. Thank you all so much, and I hope you enjoy the rest of your day. Bye, everyone.